This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. We're revisiting some of the smart insights, tips, and advice from our past guests on the show. I hope you enjoyed this episode. Thank you for joining us. Today we are back with our How to Invest series, and we'll expand on biotech and life science subject. Today we'll be revisiting our guest answers to a different question: what's your advice on people investing in startups in this sector? Our first guest is Dennis Coleman of Life Science Angels. Life Science Angels is a not-for-profit angel group based in Sunnyvale, California. They are the nation's premier healthcare-focused angel investment organization. They have established two separate committees to review medical technology and biotechnology investment opportunities. Members make their own investment decisions, but the investments are made through a single LLC. Typical investments range from $200,000 to $600,000, with syndicated financings ranging from $2 to $3 million. Let's hear how he answered this question.
Say goodbye. So you should sort of think of how much money do you want to commit to this and figure that you're never going to see that money again. And let's say that's X dollars. And then you should invest that X dollars in a minimum of 4 startups, because they're not all going to hit. Matter of fact, most of them are going to miss. And you're not going to get that portfolio effect risk reduction if you don't do several of them. And that's why an angel group is really important, because in our group here, I can't remember what our number is for individual. We have to get $200,000 from among all of us before we'll invest. But you can invest, I don't know whether it's $5,000 or $10,000. So you can invest in several. Where if you're out on your own, you're just not going to get people's attention unless you invest 25 or more. So for people getting started, that means you got one investment, and that just is not a good idea. You should join a group because you need people to talk to. You know, I find it very valuable, and I learned so much from the technical leaders in the various areas in our field. And when you're going after an antibody for COVID, and you're going after a device to embolize tumors, it's totally different people that you're talking to, because nobody can understand everything about the area. And I get a lot talking with people who are just good investors. And, you know, they ask me good business questions, and reading the characters of the people who are often technical who come in to present. So I guess my advice is join a group, make several investments, and learn from people. And that's sort of part of the whole thing. And that's sort of why you do it here. You know, the people you know, the interesting entrepreneurs you meet. Anyway, for me, that's a big part of it. And when I say, you know, keep an idea of your budget here, what you're going to invest. You know what I have to do? I have to limit myself. I see so many things I like. I got to say, Dennis, no. You know, you got to keep investing at a reasonable rate here, but don't get too excited one year. I mean, then you won't have as much for next year.
Our next guest is Ipshita Mandal-Johnson, founding partner and CEO at Global BioFund. GBF is a value capital fund with a gender-smart lens, investing in biosectors, including digital health. They invest and scale women-led bioventures at early and growth stages, especially those based in the U.S., U.K., Australasia, and selected high-growth emerging markets. They have created GBX, a network that consists of a diverse and experienced group of investors, entrepreneurs, scientists, experts, and organizations that support women-led bioventures that are growth and impact-oriented. What is her advice for people investing in startups in this sector? Let's find out.
I think a lot of the backgrounds of investors I've seen and worked with or raised capital from as well, I think we've got a very structured, very high professional backgrounds coming from finance sector or consulting or banking, and which is great because at the end of the day, we are making money. However, I feel having grown startups, and I think that's a benefit Georgia and I've both had as we've built companies before, we see there's a lot more than the numbers and the business plan. There's a lot more to, you're investing in people. Business is about people and startups is about people. So when we look at teams, and I think that's the advice to investors, is not looking for me toos. We're not looking for people who just look like us and behave like us. And that's where that diversity of entrepreneurs, not just the CEO or the founder, you're really looking for the team. That I think is what's quite important. And we find when there's more gender balance in teams, you do see more better ideas, more creativity, and better risk analysis coming through. So for investors focusing beyond the finance and the business plan, you're investing in people. So that is probably the biggest advice or tip or flag that I would suggest to other investors.
Our next guest is Mark Groper, President and CEO at Orion Biotechnology. Orion Biotechnology is a clinical stage biopharmaceutical company focused on discovering and developing best-in-class immunotherapeutics based on novel recombinant chemokine analogs. Their goal is to significantly improve the health outcomes of populations affected by serious disease in the area of oncology, neuroinflammatory disorders, inflammatory bowel disease, HIV, and others. Let's hear his advice for people investing in startups in the healthcare sector.
Well, I think the key things that our shareholders have found attractive about Orion's investment opportunity are, number one, that we have a unique scientific approach that has the potential to open up a very large and in high demand market. So it provides a unique value proposition. They do look, for demonstrated success. So the fact that we have progressed, for example, our lead candidate through to successful completion of a phase 1 clinical trial demonstrates that Orion has the ability to successfully execute clinical studies of this type. And I think, as I mentioned, they also look for risk mitigation. And we are very fortunate at Orion to have benefited from shareholders that are very experienced biotech investors. So we have some very high profile investment groups in our shareholder base, including, for example, the Wellcome Trust, which is a very large UK-based biotech investment fund.
Our next guest is Allison Piper Kimball, managing partner at Wave 27 Ventures. Let's hear her thoughts.
Oh, that's a big question. It obviously completely depends on the nature of the company and what their financial risk tolerance is for the individual investor. Many of these, investment groups, angel networks and things do have special purpose vehicles that a first-time investor can enter into with, less capital at risk and participate in reviewing the companies, together with a group. So if they are, unsure about putting a large dollar amount into an investment at first or wanting to make sure their portfolio is as diversified as possible, sometimes joining into a special purpose vehicle is a good first step to just understand the process and see how things work and not have to put as much capital at risk. But in my experience, it's been wonderful having a very educated group of other angel investors to be able to look at a deal with, so that you've got expertise and, the ability to get questions answered from people who are more knowledgeable than you in their areas.
Our last guest is Neal Vail, Chief Technology Officer and co-founder at Progenitive Medical, Inc. Progenitive Medical is a pre-commercialization stage medical device company focused on expanding clinically proven reduced pressure therapy into spinal and orthopedic indications. Their initial clinical application is to significantly improve clinical outcomes and satisfaction in patients undergoing spinal fusion procedures, a new annual revenue opportunity of $1.6 billion in the U.S. market.
Well, the first thing I ask them to do is make sure you understand what your risk tolerance is. If you're doing early stage investment, you've got to be able to have a high degree of risk tolerance, because it's highly, there's a possibility that investment may never resolve itself into something of any value. Once you've understood that, then you also need to understand too that any money that you're going to be putting into an investment is something that should not be targeted towards anything else that you need to survive on. You already got standing investment capabilities, you've got the need to live and survive and so forth. And so any kind of money that you think about doing an investment from an angel perspective is something you got to be willing to lose and recognize that it's not going to hurt you in some way should you lose it. With that being said, getting into the actual investments themselves, the things that I look for is that first and foremost, I got to be able to understand what the opportunity is. Can they describe it to me and I can grasp it fully and understand how does this product work? What need is it addressing? And is there some way the value can be realized from that? So, starting off, those are some of the first things that I'm going to be asking myself. And then most importantly, in some of that, once you have an opportunity as you're exploring with doing an investment, who's this team and are they the right team to be bringing that forward? Are these the guys, or these the individuals who are going to be able to execute on their plan? They have market experience. They understand what is needed to get the product through and so forth onto the market. And are they the right team to be doing? So those are some things that I consider and my recommendations as well.
In summary, the key takeaways from the guests from today's episodes are: set a budget and be prepared to potentially lose the invested money, considering diversification by investing in multiple startups through an angel group to reduce risk. Focus on investing in the people behind the startups, seeking diverse and capable teams, which can lead to better risk analysis and successful ventures. Look for startups with a unique scientific approach, demonstrated success, and support from experienced investors to mitigate risks. Understand your risk tolerance and start with lower risk opportunities, like special purpose vehicles, to learn and gain insight from experienced investors. Assess the investment opportunities carefully, understanding the product's value proposition and the team's capabilities in executing the business plan. I hope you found their perspectives valuable and applicable to your own venture capital endeavors. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.